Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by President and Head of Portfolio Strategy, Nicholas Bohnsack. Nick, how are you doing today?
I'm really well, Ross. Nice to chat with you. Thanks for having me.
Yeah, absolutely. And fortuitous timing. We our long national nightmare is over. The shutdown has ended. So I want to get your thoughts on the implications of the shutdown being so long, what that might mean for 4Q, and then what you're keeping your eye on going forward as well.
Yeah, I think as we before the government shutdown, as we were sort of coming through the Labor Day holiday, we had already started to see some rockiness, some unevenness in the labor market, and of course that has its natural knock-on effects to consumption. And so we did start to see some of the September consumer data and some of the private October consumer data start to roll over. And I'm afraid that the shutdown lasting more than 40 days only exacerbated that. If you go back and look at shutdowns historically, almost irregardless of their duration, they tend not to have an undue and lasting negative effect on the economy. But this one probably exacerbated some of the choppiness in the labor market. So it's certainly a positive that it's over. And some of the social concerns related to the supplemental benefits for food, obviously, and even the irritation as it relates to travel and the impact on leisure. Those are all going to show up, in probably some slightly weaker 4Q economic data.
Yeah, absolutely. So we've got this, call for a 4Q soft patch, but with some tailwinds heading into 2026. And I want to get your takeaway both on what companies have been saying, as we wrap up an earnings season here, about how they're thinking about forward guidance and the outlook for 2026, and then also maybe touch on Strategas's call for a consumer boom that's helped by some stimulus that comes online next year.
Yeah, I think there's a modest disconnect. I don't want to draw too wide a chasm, but there's probably a modest disconnect between some of the real-time economic data, and I use that somewhat tongue-in-cheek to the extent to which we didn't get a lot of official data here in the last month. But there's a disconnect between the economy here in 4Q and the picture that corporate operators are painting. We're seeing a little bit of widening of corporate credit spreads. That's probably a response to some of the unevenness and choppiness here in the fourth quarter. But earnings were a resounding positive for 3Q. We saw year-over-year growth touch at 14% on the bottom line. I think even more impressive, we saw top line growth edge up towards 8%. That's effectively twice the rate of nominal GDP growth for the quarter. You tend not to get into too much trouble until you see that growth rate in the top line, get down and sort of inside the level of the GDP growth rate. So, a lot of good news from corporate operators. And as much as we've been hanging quarter to quarter on the outlook for CapEx spending in the artificial intelligence sleeve, we saw a broadening of sort of the outlook for strength next year. Typically with the third quarter reporting period, corporate management tends to sort of guide a little bit lower, lower the expectations to create an easier playing field to surprise next year. We didn't see that in earnest this time around, and maybe we were shaking off some of the effects of the mess that was 2Q, post Liberation Day and some of the uncertainty there. But all in a pretty positive landscape and picture painted by corporate operators. I would add, just in conclusion to that point, that the outlook for 2026 on the corporate profit front remains rather rosy as well. By coincidence, the expectation for growth for the full year is another 14% on the earnings side. That will require a modicum of margin expansion because the revenue expectation is just slightly lower than what we saw in the third quarter at about 6%. So all in, the market is probably going to look through the unevenness, many of the choppiness we see here in 4Q, and really start to grab hold onto what it thinks will be, pretty positive landscape for next year. I'll pivot just to make a quick point and on this idea of what lies ahead of us. In sort of an odd construction, the One Big Beautiful Bill tax legislation that was passed in July, and irrespective of one's political proclivities, it was written so that the lion's share of the benefit doesn't really accrue to the economy until 2026. We had about $100 billion of corporate tax credits or capital investment incentives that were in 2025. We'll get another $135 billion in 2026. That's a pretty good support mechanism for capital spending. And then we'll get $150 billion of tax refunds to American taxpayers, but those will come in the form of checks, which will not be issued until in and around the April reporting window. So we've got a little bit of a lag here between passage of the bill, some choppiness in fourth quarter, and then ultimately that consumer wave you mentioned manifest in 2026. But all in, a generally positive outlook for investors.
Yeah, I think a lot to look forward to in 2026. It's hard to say, we're looking for the light at the end of the tunnel, given how good things have been, but certainly a lot to look forward to next year. So this has been super insightful, great insights on the building blocks of this whole thing. Want to thank you for the time and look forward to talking to you again soon.
Yeah, likewise, Ross. Thank you.